welcome to Random Gleanings. I am Chris. He is Jesse. Jesse, it is still financial planning month in October, and we said we were going to talk about Roth conversions.
Indeed.
Let's talk about them. So you pulled this graphic out and noted that the Trump tax cuts from 2017 are set to expire in 2025, which means tax brackets, actually, the amount you pay would go up.
Yeah, and interestingly enough, the maybe most punitive of those sunsetting tax law happens at the lower brackets, right? So again, nothing says that this is definitely going to not be adjusted by the end of 25, but if they do nothing
in 2026, tax brackets
in
rise.
2026,
right.
Tax brackets for most of us are going to rise. That's exactly right.
Okay, so this next graphic, this is the tax brackets as they stand now, and let's walk through it with an example.
Yeah, so this is going back to an example that you kind of teed up a couple weeks ago, and at the time we were talking about maybe making sure that you saved more in a tax deductible situation. Now we're actually kind of flipping the script a little bit and saying, hey, maybe based on your saving strategy, there might be a little room to push something into a Roth. So we're going back to a married filing jointly couple earning $140,000.
Yep.
And collectively they're saving $30,000 in their 401k, which reduces their adjusted gross income to $110,000, and a standard deduction brings them down to $82,300, which puts them squarely. Their top marginal bracket is the 12% bracket, right?
So ultimately, what that means then, an 89,450 is the top of the 12 bracket. So that means they could get $7,150 out in a Roth conversion.
Bingo.
They would never ever pay another dollar of tax beyond that 12%.
So they owe 12% on the $7,150 when they do that. But let's just, I think between the two of us, no-brainer.
Yep.
A no-brainer to go ahead and pay the tax on that now. Unlikely that you're going to have another situation where 12% is going to be your top end on that.
Right. But looking forward as we get closer to 2026, when, the sunset December 2025, this is what tax brackets would look like now or in 2026 in this next graphic. Now, the numbers may shift up a little bit, but that's what they're set to be in 2026 as it stands.
Right. So just so everyone knows, married filing jointly or single, those will adjust with inflation likely.
Right.
But if we're just using today's dollars, the 12 is going to 15, 22 is going to 25, and 24 is going to 28.
Right.
So maybe, as you think about this, there's some opportunity in the next 3 years, the remainder of this year, 24 and 25, to at least run the numbers for yourself to understand, hey, am I doing myself a favor now by putting these dollars in an account type that's not going to be taxed again?
All right. So why might we pay more now for higher tax brackets later? I mean, do you think tax brackets are going to go up? I'm not saying they will, but I mean, we kind of have big budget deficits to pay for, right?
Got a big debt, and the cost of that debt.
Yeah, the cost of that debt is going up big time.
The interest expense on that debt. Yeah.
I mean, 2 years ago, the rate on a 10-year note was 1.5, somewhere in that neck of the woods. And today, it's, as of this recording, it's what, 460, 470, somewhere in that neck of the woods. I mean, that's a lot of interest cost, right? So Uncle Sam may have more to pay for in the future. So if that's the case, let's look at the rest of the conversions, right? Like, you could still get your 12% out, but technically you could go to another $101,300 at the 22 bracket, which is set to move to 25.
So let me pause you there. So again, we're looking at a 52-year-old couple, right? Presumably in this example, these folks have done a good job saving in their IRA, 401k, whatever,
right,
along the way, such that they've got a big nest egg saved up. Again, unique situation and worth running the numbers on for these folks.
Right.
But as we just said, that 22 is going to 25, barring no congressional changes.
Right.
So,
and you'd want to talk to your tax advisor about this.
That's right.
I mean, you'd want to make sure you had all your ducks in a row. But I mean, you could get another $101,300 out at 22%. And by the way, you could have that with that the tax owed withheld from your IRA or from your 401k in that process of conversion. Now, your 401k would have to allow you to do that conversion, but assuming you can, that can be withheld from those dollars in the process. Yeah. Now, ideally, you'd pay it out of pocket, but your couple making 140 with, adjusted or taxable income at 82,300, they probably wouldn't be able to write that check.
It's going to be a hard check to write.
But, I mean, if you know or feel like tax rates are going to be higher in the future, well, then it's at least worth knowing what you could do, right? Because technically you could do another 173 on top of that. I mean, technically you could do, $290,000 in that situation and be beneath that 25 bracket, right?
That's just it. So, again, unique scenario, talk to somebody, talk to your tax advisor, consult with us. As to running these scenarios for you, but ultimately, this may work out to your advantage for a number of reasons. Let's walk through those.
Yeah, the first is lower tax obligations on your nest egg in the future, right? Like you would have paid the tax on that money, so you're not paying tax on it again.
It's kind of, I tell people all the time, I love having access to traditional IRA money, Roth IRA money, and preferably some non-qualified money, so as to best structure how you want to, pull your income in retirement, so that you are paying effectively the tax that you would like to pay.
Right, which is our second point here, which more flexibility in retirement income because you're required to take less from your IRA because you've already done it.
That's right. So again, this is important because RMD is going to require you to take that money out whether you need it or not.
Right.
But not on a Roth. An RMD is not required on a Roth.
That's right. And finally, in an era where your beneficiaries are now required to take out those dollars from your IRA that they inherited within 10 years, at potentially their highest tax bracket. So think about that, okay? I mean, if you pass in your late 80s, right, and you had kids at 30, well, that means your kids are in their 50s, and that they're probably somewhere near their highest tax bracket earning years in that process. But if it's already in a Roth, they're going to inherit it tax-free.
Yeah. Again, the 10-year thing was definitely a revenue increaser for the government, and there's just no doubt about that. But again, the scenario is I've gone from $140,000 of income to $250,000 or $300,000 of income, and now I've got to start taking money off of Dad's money in a 10-year period. It's only pushing my taxes higher.
Right. That's right. Okay. Let's talk markets. Market's been a little bumpy.
It's gotten a little bumpy. That's right. As history suggested that September is not the greatest month, that came to fruition this year. You found a stat as to what happens sometimes in October.
This is a great chart from our friends at Bespoke. Since 1945, October is the month that has had the most bottoms when the S&P has pulled back 5+%, which it's done an awful lot of in Septembers since 1945.
It has, and last year was an example of this. In that October saw the bottom of the 22 market. So,
yeah, but it's really weird what's been holding up well versus what hasn't. You would expect if we were going to have challenging times that defensive type stocks, healthcare, utilities, staples would do well. I mean, utilities got crushed yesterday.
Gosh.
And what's holding up well? Well, energy, relatively speaking, or at least it has over the course of the last month, 2 months or so. But then tech, too. It's continued to do very well.
This is a kind of a change for one's thinking, but it goes back to something that we've talked about, which is we've said this on air here, that those of us with a 3% mortgage and not in need of borrowing money, what's the interest rate increase mean to us? It doesn't really affect us at all. And I think that's maybe where mega cap tech has this real strength right now.
Right. I mean, if you look at the economy, again, the market may be a forward-looking animal, but you can't look out here and say you see a recession anywhere in sight. Next chart, if you look at the Atlanta Fed's GDP now graphic, and this is through last night, I mean, it's still solidly up in the high fours in terms of growth in the United States. And what they're saying in this blue chip consensus is, if you look at 10 of the blue chip economists, they still have the economy growing at 3%. That's not a recession.
It's not. So it does not seem, based on this data, that we are on the precipice of a recession. So where is the trouble coming for in stocks if this is not what's happening?
Well, some of it is where markets ought to be valued, and the thing is interest rates were climbing on the longer end of the yield curve, meaning 5-year bonds, 10-year bonds, 20, 30-year bonds. It was rising over the first half of the year. It didn't have any impact on stock prices. It's climbing further now and
Faster,
and seems to now be having an impact. Is that right or wrong? No way really to know. But if you think about margins, if you think about the consumer, obviously the consumer's having to pay more in terms of any borrowings that they have on a variable basis, right? And so the question is, to what extent are they impacted by interest rates? I mean, if your business doesn't have to borrow more money at higher rates, well, then it's had zero impact on you.
That's
right.
Yep.
I mean, if your household hasn't had to borrow money at higher rates, it's really had zero impact on you.
And for a business, that equates to margin compression for profits, right?
Right.
And so Liz Ann Saunders speaks to a household in that the households are paying a higher rate of interest expense than they have for quite some time. And perhaps we're seeing that happen in maybe some of the smaller companies out there in the economy, and that margin compression may be squeezing their ability to continue, not so much earnings, but just the profitability of the company.
Well, but there are companies that haven't had margin compression.
Absolutely.
I mean, if you're not borrowing money right now, you haven't had margin compression. Now consumers may slow, or your customers may not buy your product, but ultimately, I mean, technically, if you've raised prices for your product, but you don't have any more costs because you haven't borrowed, I mean, you're making more money.
Right. That's right.
Plus, if you have cash, you're actually making money on your cash too.
Right. As we pointed out last week with Microsoft.
Yeah.
Holy cow.
So, I mean, definitely personal interest payments are starting to cost consumers more, and that is a concern. I mean, if the consumer slows, it will have an impact. But the question is just how much. Obviously, with GDP now, it hadn't happened yet.
That's right.
So we'll see. So I saw this. Our friend Jim Bianco made some comments on a Bloomberg article that Ozempic seems to maybe be having some positive impacts on airlines making more money. Because if flyers lost 10 pounds each, they'd save United $80 million annually.
There's a way to get some margin back. That's very, very interesting, and it's just quite funny.
So the scale may not just be for your luggage next time you're there. Maybe for you.
Man.
Get excited about that.
Yeah.
Hey, listen, I've got some work to do there too.
Yeah, likewise.
You got anything else?
No, I don't. Not this time. You?
Nope. Thanks so much for watching. We're grateful to you as always. Please do click the subscribe button. Again, Financial Planning Month. Do something to move your household forward in terms of finances. If we can help in any way, please reach out. Please do click the bell as well to be notified when we post. Thanks so much as always.